What we're basically looking at here is the European equity volatility trading near record lows, very close to record lows. The European equity market basically has just gone to sleep in some respects. Let's get Stephen Macklow-Smith's take on this, JPMorgan Asset Management's head of European equity strategy. What do you make of that low vol? What does it tell you about the investment opportunities that are here?
Well, you talk about the market going to sleep. I'm not sure that you would really characterise a market that's performed in the way that the European market has so far this year as having gone to sleep exactly. I think the opportunities are there if equity growth, European earnings growth holds up, and the signs for that are reasonably good. Normally, as you come into the year, you have a spate of earnings downgrades as analysts take the knife to their forecasts for the year forward as it sort of heaves them aside over the horizon. This year was no exception, but those downgrades were about 2%. You've still got expected earnings growth in Europe of 6 to 7, which actually is higher than consensus is expecting in the States.
Is the European market going to outperform the US market this year?
I think an enormous amount depends on whether that earnings number actually holds up. And for that, you need to focus on what's going on in emerging markets rather than domestically in the Eurozone economy. I mean, look, most European companies are aware of the fact that European growth domestically is challenged. So although they're very happy to do business here, when they're thinking about investing capital, they tend to do it overseas in higher growth markets. In the last 2 or 3 years with the slowdown that you've seen in emerging markets, that hasn't really helped them. But if emerging markets are stabilizing, if the dollar's stabilizing at these high levels, you're not going to see a further rally in the dollar putting pressure on emerging market currencies, then actually the European earnings number could be a real number and the valuation is fairly attractive.
Stephen, it's a bit of a distance, but do you buy the idea that U.S. technology is overvalued?
Tom, it's a really interesting question. I mean, no, not necessarily. We have a regular kind of 6-monthly powwow with our senior investors, and we have people in America who are much cleverer than I am. One of the points that they make is that where in 2000 tech valuations were extremely elevated, there was not really a profit story there. Now you are getting substantial earnings out of the technology sector, and those earnings are continuing to grow. So actually, you know, I think those valuations are justified. Now, the issue you slightly face with that is there was a big setback in technology in the third, fourth quarter of last year, and I think one of the reasons that you had that was that these are fairly long duration assets, and when interest rates move up, you rebase the valuation. So depending on what your view on US interest rates is, and you know, from our point of view, we can't see long rates in the States really running away, although we think that where they are currently is at the low end of a range. But as long as you don't get a reset of US long-term interest rates, then I think those tech valuations are sustainable.
You have to participate in the markets. We're all under that pressure. Right now, the worry that's out there, and I would suggest it's a massive wall, a nuanced wall of worry. Is it a wall of worry about revenue? Is it a wall of worry down the income statement? Is it a wall of worry about exogenous shocks? What's the character of the worry right now?
Well, I think that there's a lot going on in the background on in the political sphere that people are concerned about, and specifically where that manifests itself in the P&L, to your point, is in trade, because I think that the measures that have been taken by the US administration to try and renegotiate their relationship with China, and the threats that have been made that the measures that they have adopted against China will be adopted against the European autos industry. All of those things bear down on industrial confidence, and you saw a dramatic decline in confidence indicators in the manufacturing sector last year, and I think that cannot be unrelated to issues over trade. Because if you're a company and you're thinking about the notion that trade between countries might be made more difficult, if you have an extended supply chain across frontiers, then inevitably you're going to rethink about where you commit your capital, but you're going to wait for clarity before you do that.